If you walk through the financial district of Manhattan today, you will see towering monuments to American capitalism. You will see the New York Stock Exchange with its marble columns and its American flags snapping in the wind. You will see the bronze statue of the charging bull, a symbol of market optimism and endless growth. The story we tell ourselves about Wall Street is a story of innovation and opportunity. We are taught that the stock market is the engine of prosperity, that it allows ordinary people to share in the wealth of the nation. We are taught that the regulations put in place after the Great Depression, the reforms of the New Deal, were necessary corrections to prevent another collapse. But there is a different version of this story. It is a version that you will not find in the economics textbooks of Harvard or Wharton. It is a version that is remembered with bitterness in the breadlines of Detroit and the foreclosed farms of Oklahoma. In this version of the story, the Great Depression was not an accident of nature or an inevitable cycle of capitalism. It was a crime scene. It was the direct result of a financial elite that gambled with other people's money, rigged the market with fraudulent schemes, and then walked away from the wreckage while millions starved. This is the story of how Wall Street destroyed the American economy. It is the story of how bankers turned the stock market into a casino, how they used borrowed money to inflate a bubble that was destined to explode, and how when the bubble finally burst, they protected their own fortunes while the working class was left to die in the streets. It challenges the myth of the Roaring Twenties and reveals the cold financial recklessness that turned prosperity into the worst economic catastrophe in modern history. To understand this theft, we have to look past the ticker tape parades and into the boardrooms of Lower Manhattan. In the 1920s, the United States was riding a wave of unprecedented optimism. The First World War was over. American soldiers had returned home as heroes. The country was booming. New technologies like automobiles, radios, and electrical appliances were transforming daily life. Henry Ford's assembly lines were churning out cars that ordinary workers could afford. For the first time in history, it seemed like the American dream was within reach for everyone. The stock market became the symbol of this new prosperity. In the early 1920s, stocks were still seen as investments for the wealthy. But by the mid-1920s, a new culture had emerged. Everyone wanted to get rich quick. Shushin boys, secretaries, factory workers, they were all buying stocks. They read the financial pages of the newspapers like they were reading the sports scores. They gathered in brokerage offices to watch the ticker tape, cheering as the numbers climbed higher and higher. It was a national mania. But there was a secret behind this boom, a secret that would eventually destroy the lives of millions. The stock market rally of the 1920s was not built on real economic growth. It was built on debt. It was built on a financial weapon called buying on margin. Margin buying was a simple but dangerous concept. It allowed an investor to buy stocks with borrowed money. Here is how it worked. Let us say you wanted to buy $1,000 worth of stock. In a normal world, you would need $1,000 in cash. But with margin buying, you only needed to put down 10% or sometimes even less. You would pay $100 of your own money, and the broker would lend you the other $900. If the stock went up, you made a fortune. If a stock you bought for $1,000 rose to $2,000, you could sell it, pay back the $900 loan, and walk away with a profit of $1,000 on an initial investment of just $100. It was a 1,000% return. It seemed like magic, but there was a catch. If the stock price fell, you still owed the full amount of the loan, and if the stock fell too far, the broker would issue a margin call. They would demand that you immediately pay back the loan. If you could not pay, they would sell your stocks to cover the debt. And if the sale did not cover the full loan, you still owed the difference. It was a ticking time bomb. And by 1929, the entire American economy was wired to explode. The scale of margin debt in the late 1920s was staggering. By 1929, margin loans totaled over $5 billion. To put that in perspective, that was nearly 10% of the entire gross domestic product of the United States. It was more than the total amount of currency in circulation in the country. The stock market had become a giant pyramid of debt, with each level supported only by the hope that prices would keep rising forever, and Wall Street loved it. The brokers and bankers made a fortune on margin loans. They charged interest rates of 10%, 12%, sometimes 20% on the borrowed money. It was free money for them. They did not care if the borrowers could pay it back. They did not care if the stocks were overvalued. As long as prices kept going up, everyone made money, and if prices ever fell, well, they would just seize the collateral. The borrower would be destroyed, but the banker would survive. But margin buying was only one part of the fraud. The second weapon in Wall Street's arsenal was the investment trust. Investment trusts were the hedge funds of the 1920s. They were companies whose only business was to buy stocks in other companies. An investor would buy shares in the investment trust, and the trust would use that money to buy a portfolio of stocks. It sounded reasonable. It sounded like diversification. But the investment trusts of the 1920s were not designed to protect investors. They were designed to enrich the men who created them. The structure of these trusts was a masterpiece of financial deception. A bank or a brokerage firm would create an investment trust and sell shares to the public. Let us say they raised $10 million, but instead of using that $10 million to buy $10 million worth of stocks, they would use margin to buy $50 million or even $100 million worth of stocks. The trust itself was leveraged. It was borrowing money to gamble, and it got worse. The investment trusts would often invest in each other. Trust A would buy shares in Trust B. Trust B would buy shares in Trust C. And Trust C would buy shares back in Trust A. It was a circular scheme, a house of cards built on leveraged bets on leveraged bets. There was no real value anywhere in the chain. It was just a pyramid of paper wealth. The men who ran these trusts became legends. There was Charles Mitchell, the president of National City Bank, one of the largest banks in America. Mitchell was known as Sunshine Charlie because of his relentless optimism about the market. He told the American people that stocks would never go down. He encouraged ordinary citizens to invest their savings. But behind the scenes, Mitchell was running his own investment trust, using depositors' money to buy stocks on margin and paying himself enormous bonuses from the profits. There was Richard Whitney, the vice president of the New York Stock Exchange, a man who came from one of the oldest and most respected families in America. Whitney was the public face of Wall Street integrity, but he was secretly embezzling funds and running Ponzi schemes to cover his gambling debts. And there was Samuel Insull, a utilities magnate who built an empire of interconnected holding companies. Insull's companies owned other companies, which owned other companies in a dizzying web of corporate incest. At the center of it all was nothing. It was financial vapor, but on paper, Insull was worth billions. By the summer of 1929, the stock market had reached levels that defied all logic. The price-to-earnings ratios of major companies were astronomical. Stocks that paid no dividends were trading at 50 or 100 times their actual earnings. It did not matter. The belief in perpetual growth had become a religion. The high priests of this religion were the economists and the bankers who assured everyone that the fundamentals were sound. Irving Fisher, one of the most respected economists in America, famously declared in October 1929 that stock prices have reached what looks like a permanently high plateau. He said this just days before the market collapsed. He was not lying, he believed it. He had convinced himself that the new era of prosperity was different, that the old rules no longer applied. He was catastrophically wrong. The first cracks appeared in September of 1929. Stock prices began to wobble. There were a few days of sharp declines, followed by recoveries, but experienced traders could sense that something was wrong. The volume of selling was increasing. The margin calls were starting to go out. On October 24, 1929, the dam finally broke. It was a Thursday, forever remembered as Black Thursday. When the opening bell rang at the New York Stock Exchange, A wave of sell orders flooded the market. Everyone wanted out at the same time. The prices began to plummet. Within the first hour of trading, the ticker tape, the machine that printed out the stock prices, fell behind. It could not keep up with the volume of transactions. Investors across the country were watching the tape, seeing their fortunes evaporate in real time, but they were seeing prices that were 30 minutes or an hour old. By the time they called their brokers to sell, the prices had fallen even further. Panic spread through the trading floor. Grown men, millionaires in the morning, were reduced to tears by noon. Some traders fainted, others vomited. The noise was deafening, thousands of brokers shouting orders, the clatter of the ticker tape machines, the ringing of telephones that no one could answer. By midday, a crowd had gathered outside the exchange on Wall Street. They stood in silence, staring up at the building, waiting for news. Rumors flew through the crowd. Some said that 11 speculators had already committed suicide. Some said that the Chicago exchange had closed. Some said that the federal government was sending troops to restore order. None of it was true, but in the fog of panic, truth did not matter. Inside the exchange, a group of the most powerful bankers in America held an emergency meeting. They were led by Thomas Lamont of J.P. Morgan and Company. They decided to intervene. They pooled their resources and began to buy stocks, trying to stop the collapse. For a few hours, it worked. The market stabilized. Prices even recovered slightly. The newspapers the next day ran headlines proclaiming that the worst was over, that the bankers had saved the day. But it was a lie. The bankers had not saved the market. They had only bought themselves time to sell their own holdings. The following Monday, October 28, 1929, the market collapsed again. This time there was no rescue. The selling was relentless. And then came Tuesday, October 29, 1929. Black Tuesday. It was the worst day in the history of the American stock market. Over 16 million shares were traded, a record that would stand for decades. The Dow Jones Industrial Average, the main index of stock prices, fell by 12% in a single day. Fortunes that had taken years to build were wiped out in hours. By the end of the day, $14 billion in market value had vanished. In today's money, that is roughly $200 billion gone in 6 hours of trading. But the real horror was not in the numbers. It was in what those numbers represented. The stocks that crashed were not just pieces of paper. They were the savings of millions of ordinary Americans who had believed the promises of Wall Street. They were the retirement funds of teachers and shopkeepers. They were the college funds of children. They were the dreams of families who had scraped together every dollar to buy a piece of the American dream. And now it was all gone. The margin calls went out like a plague. Brokers demanded immediate payment, but the investors had no money. They had borrowed everything. So the brokers seized the stocks and sold them, driving prices even lower. It was a death spiral. The more stocks they sold, the lower the prices fell. The lower the prices fell, the more margin calls went out. The more margin calls went out, the more stocks had to be sold. It fed on itself, devouring everything in its path. Within weeks, the contagion spread beyond the stock market. The investment trusts, those great pyramids of leveraged debt, collapsed completely. When the stocks they owned fell in value, they could not meet their own debt obligations. They defaulted. The trusts that had been worth billions were suddenly worth nothing. The banks that had lent money to the trusts and to the margin buyers found themselves holding worthless paper. They had loaned out billions of dollars secured by stocks that were now trading for pennies. The loans would never be repaid. The banks began to fail. Bank failures in the 1930s were not like bank failures today. There was no deposit insurance. If your bank went under, your savings were gone forever. When rumors spread that a bank was in trouble, depositors would rush to withdraw their money. This was called a bank run. But banks do not keep all their deposits in cash. They lend most of it out. So when everyone tried to withdraw at once, the bank would run out of money. It would close its doors. The people at the back of the line would lose everything. In 1930, over 1,300 banks failed in the United States. In 1931, over 2,200 banks failed. By 1933, nearly half of all the banks in America had closed. Over $140 billion in deposits, in today's money, simply vanished. Families that had saved for decades found themselves with nothing. Elderly couples who had counted on their savings to live out their final years were left destitute. The collapse of the banks destroyed the real economy. Businesses could not get loans. Factories could not buy raw materials. They began to lay off workers. The workers, now unemployed, could not buy goods. So businesses cut production further and laid off more workers. It was a vicious cycle of contraction. By 1933, unemployment in the United States reached 25%. 1 in 4 American workers had no job. In the cities, breadlines stretched for blocks. Men who had once been respectable professionals stood in line for hours to receive a bowl of soup and a piece of bread. In the countryside, farmers who could not pay their mortgages were evicted from their land. Banks seized farms that had been in families for generations and auctioned them off for pennies on the dollar. But often there were no buyers. The land sat empty, the crops rotting in the fields. The Dust Bowl made it worse. Years of overfarming and drought turned the Great Plains into a desert. Massive dust storms, black blizzards they were called, swept across the Midwest, burying entire towns under drifts of dirt. Hundreds of thousands of families packed up their belongings and fled west, hoping to find work in California. They were called Okies, refugees in their own country. They lived in camps made of cardboard and scrap metal. They worked as migrant laborers for starvation wages, picking fruit in the orchards of wealthy landowners who treated them like animals. Children died of malnutrition and disease. It was a humanitarian catastrophe on American soil. And what of the men who had caused this disaster? What happened to the bankers and brokers who had gambled away the savings of the nation? For the most part, they were fine. Charles Mitchell, Sunshine Charlie, was eventually charged with tax evasion, but he was acquitted. He paid a small fine and went on to work for another bank. Richard Whitney, the vice president of the New York Stock Exchange, was finally caught embezzling funds in 1938. He went to prison, but only for a few years. He was released early for good behavior. Samuel Insull fled the country to avoid prosecution. He was eventually extradited and put on trial, but he was acquitted. The jury believed his lawyers when they argued that he had made mistakes, but had not committed crimes. J.P. Morgan Jr., the head of the most powerful bank in America, was called to testify before Congress. During the hearing, a circus promoter brought a female dwarf and placed her on Morgan's lap as a publicity stunt. The photograph ran in newspapers around the world. It made a mockery of the hearings. Morgan himself was never charged with any crime. The financial elite had destroyed the economy, but they faced no real consequences. They had insulated themselves. They had sold their stocks before the crash. They had moved their money into cash and gold. They had shorted the market, betting that it would fall, and made fortunes on the collapse. While the American people starved, the men of Wall Street counted their profits. President Herbert Hoover, who was in office when the market crashed, was paralyzed by his own ideology. Hoover believed in laissez-faire capitalism. He believed that the government should not interfere in the market. He believed that the economy would correct itself if left alone. He was wrong. Hoover refused to provide direct relief to the unemployed. He refused to regulate the banks. He refused to launch public works programs to create jobs. He told the American people to be patient, that prosperity was just around the corner, but prosperity never came. The Depression only got worse. By 1932, Hoover was the most hated man in America. The shantytowns where the homeless lived were called Hoovervilles. The newspapers that the homeless used as blankets were called Hoover blankets. The empty pockets turned inside out were called Hoover flags. In the election of 1932, the American people turned to Franklin Delano Roosevelt. Roosevelt promised a New Deal for the American people. He promised to regulate Wall Street. He promised to put people back to work. He promised to use the power of the federal government to save the nation from collapse. And he delivered. Within his first 100 days in office, Roosevelt pushed through a wave of legislation that transformed the American economy. He created the Securities and Exchange Commission to regulate the stock market. He outlawed many of the fraudulent practices that had caused the crash, including margin buying with less than 50% down payment. He created the Federal Deposit Insurance Corporation to guarantee bank deposits, ending the era of bank runs. He launched massive public works programs, the Civilian Conservation Corps, the Works Progress Administration, that put millions of Americans back to work building roads, bridges, dams, and schools. But the New Deal, for all its successes, could not undo the damage that had been done. The Great Depression dragged on for a decade. It did not truly end until the United States entered World War II and the government began spending enormous sums on military production. The war created jobs. The war created demand. The war pulled the American economy out of its long nightmare, but the cost was staggering. The Great Depression destroyed the lives of an entire generation. It broke families. It shattered dreams. It killed people, not just through starvation and disease, but through despair. Suicide rates soared. Marriages fell apart. Children grew up in poverty, never knowing security or comfort. The legacy of the Great Depression still shapes America today. The regulations that Roosevelt put in place, the New Deal reforms, were the foundation of financial stability for 50 years. They prevented another crash of that magnitude. But in the 1980s and 1990s, those regulations began to be dismantled. Bankers and politicians argued that the regulations were outdated, that they stifled innovation. They said that the financial industry had learned its lessons. They said that the new era of prosperity was different, that the old rules no longer applied. It was the same lie that Irving Fisher had told in 1929. And in 2008, the lie was exposed again. The financial crisis of 2008, the collapse of Lehman Brothers, the bailout of the banks, was a direct echo of 1929. Once again, Wall Street had gambled with borrowed money. Once again, they had created complex financial instruments that no one understood. Once again, they had inflated a bubble. And once again, when the bubble burst, the bankers were bailout out while ordinary people lost their homes and their jobs. The Great Depression teaches us a brutal lesson. It teaches us that financial markets, left to themselves, do not regulate themselves. They do not seek equilibrium. They seek profit. And in the pursuit of profit, the men who control the markets will take risks that endanger the entire economy. They will gamble with other people's money because they know that if they win, they keep the profits, and if they lose, someone else pays the price. It teaches us that the promise of easy wealth is always a lie. The idea that you can get rich quick, that you can buy stocks on borrowed money and watch them soar forever, is a fantasy. It is a fantasy that Wall Street sells to the public because it profits from the delusion. Every time a working-class family buys stocks on margin, the broker makes a commission. Every time an investment trust is created, the bankers skim off fees. The house always wins. The gamblers always lose. It teaches us that the men who cause financial disasters are never held accountable. They are too rich. They are too well-connected. They hire the best lawyers. They make campaign contributions to politicians. They appear before Congress and express regret, but they never admit guilt. And when the investigations are over and the public's attention has moved on, they return to their mansions and their yachts, and they wait for the next opportunity to do it all over again. The greatest crime of the Great Depression was not the crash itself. The crash was inevitable once the bubble had been inflated. The greatest crime was the refusal of the American elite to prevent the bubble in the first place. They knew what was happening. The smart bankers, the experienced traders, they knew that the market was overvalued. They knew that margin debt was unsustainable. They knew that the investment trusts were fraudulent. But they did nothing because they were making too much money. They chose short-term profit over long-term stability. They chose their own wealth over the well-being of the nation. And when the collapse came, they protected themselves and abandoned everyone else. While millions of Americans were losing their jobs, their homes, their savings, the men of Wall Street were moving their money offshore. They were investing in gold. They were shorting the market. They were profiting from the misery they had created. It was not an accident. It was not an act of God. It was a choice. It was a crime. The bronze bull that stands in Lower Manhattan today is a symbol of American optimism. But it should also be a reminder. It should remind us that Wall Street is not our friend. It does not exist to create prosperity for the masses. It exists to concentrate wealth in the hands of a few. And when we forget that lesson, when we trust the bankers and deregulate